Indian gold premiums are soaring as much as $8 to $10 an ounce over the international gold price. We'll be talking about this with Jim Wyckoff next. Thanks for joining me, Jim.
Hello, Daniela. Nice to be with you.
Jim, let's start off with the main story of the day, and that is Indian retailers paying more in order to keep up with immediate demand. Customers trying to scoop up any gold bar they can in the wake of the plunge in international prices. What are you hearing in regards to this story?
Indeed, Daniela. In fact, I've read reports of strong demand for physical gold from not only India, but from the U.S., other parts of Asia, but certainly India, the number one consuming nation of physical gold as far as the consumer goes, seeing gold bars virtually unavailable for the consumer to buy, and that has increased the premiums over the spot price of gold. I've heard reports of $6 to $8 an ounce. So indeed, very strong demand coming out of India. There's a festival that takes place in about 2 weeks, and there's going to be even stronger demand due to purchasing of gifts during that festival time.
Jim, I've actually heard from my sources that it's $8 to $10 more an ounce, and that's actually 4 or 5 times the premium retailers usually pay.
Well, Daniela, indeed, for the price of gold, this strong physical demand that we've seen worldwide has certainly limited selling interest, even in the paper market. But the strong physical demand we've seen is certainly supporting the market and may have even put in a near-term market low or helped to do so.
So, Jim, what do you do when premiums are high?
Well, it just depends, Daniela. If you think that gold prices are going still higher and they have bottomed out, then you might not mind paying the premium, even though it kind of feels uncomfortable doing so. It's a matter of where you think the price of gold is going to be in the next few weeks or few months. Speaking of which, Jim, where do you see gold headed now? Daniela, right now the gold market bulls are trying to stabilize the market, and they've done a good job of it. From a near-term basis, if the bulls can hold prices above $1,400 basis the June COMEX contract, that's going to continue to be a positive sign. We're holding just above that level as we speak today. If we produce a close back below 1,400, then the bears are going to regain a bit of downside momentum. We do have strong chart support at last week's low of 1321 and change. That's a very strong support level. For the bulls to gain fresh, strong upside technical momentum, they're going to have to produce multiple closes on a daily basis back above 1450 in the June contract. So what rating are you giving gold and silver this week, Jim? Still fully in the bearish camp as far as the overall technical posture for the gold market, so I'm giving it a 3 right now. As far as silver goes, silver's in a little worse shape. I'm giving silver a 2. In fact, we've got a bearish pennant pattern that has formed on the daily chart for May silver futures that bears watching closely. Got strong technical support in May silver at last week's low of $22. Strong overhead resistance at the $24 level, Daniela. Jim, what's causing silver being crushed right now? Well, the gold and the silver market are under pressure as we speak today due to bearish outside market forces. We've got a stronger U.S. dollar index. We've got weaker crude oil prices. Silver is also taking a little bit harder today because copper's under pressure. We had some weak manufacturing data come out of China and the European Union today, so that's also adding to downside pressure in the raw commodity sector. Yeah, we've definitely seen weak economic reports emerge from France and Spain. And Jim, I've never seen you give a metal a 2 rating. That's the lowest you've gone. Well, it's a pretty bearish reading, that's for sure, Daniela. You know, the thing with silver, unlike gold, gold might be in the same posture, but gold still is a stronger safe haven asset than is the silver market. And that's why you're seeing a little better reading in the gold market right now, because you are seeing the strong physical demand for gold as the investors and long-term holders step in to buy at what they perceive are bargain prices. All right, with the few minutes we have left, Jim, final thoughts for investors. Well, we've seen some high volatility in the gold and silver markets recently. We've stabilized the markets at present. I would not be surprised to see a bit more downside pressure in most markets, although like I say, the weekly high close last Friday in the gold market was a bullish sign. I guess the bottom line is, I think in the coming months and years, and if we look back at present price levels, we may dip a little bit lower, but I still think the present price levels in gold and silver will be looked upon in future months and years as value buying opportunities.
And Jim, when you say dip a little lower, do you mean lower than what we saw last week or lower than today?
Oh, we could dip gold and silver prices a bit lower than what we saw last week. That would not surprise me. But if you're a bullish trader, you can look at it from this way too. I think the vast majority of the downside slide that we've seen in both silver and gold has already occurred. Maybe a little bit more left, but the most of the damage has already been done.
On that note, thanks for your thoughts, Jim.
Can't wait till next time, Daniela. Bye-bye.
And thanks for watching this edition of Technically Speaking with Jim Wyckoff. You can email me at newsfeedback@kitco.com or follow this conversation at Daniela Cambone. Thanks for watching.